everyone for our last session. I will share the screen and then we may continue. And the last point we were discussing yesterday was hedge accounting. Okay, so hedging is the activity of reducing my risk by engaging in operations that have opposed risk pattern to the underlying position. So I have some business risk, and then I engage in another transaction that mitigates this risk. There are different ways how companies do hedging, but in order to qualify for hedge accounting, we have to fulfill a certain number of conditions that we mentioned yesterday. In IFRS, 3 forms of hedge accounting are accepted: fair value hedges, cash flow hedges, and hedge of a net investment in a foreign operation. This last one has the same accounting treatment as a cash flow hedge, and therefore, well, I will not present it specifically. So in a fair value hedge, as we said yesterday, the main focus is to protect my income statement. Okay, so I want to avoid losses in my income statement. Therefore, the hedge accounting or fair value hedge accounting consists in fair valuing the hedged item and the hedging item. I remember the hedging item mostly is a derivative. So we fair value the hedged item and the hedging item, and all the fair value gains and losses go directly in the income statement. That means, in particular, for the hedged item, I do not continue to apply the previous accounting rules. You know, we have accounting rules for financial instruments, I have accounting rules for inventory, etc., etc. I forget all those basic accounting rules because I'm in a hedging relationship. I do hedge accounting, and therefore, when I do hedge accounting, everything is fair valued, and all fair value gains go directly in profit or loss. Okay, let's see here in this example how this works. So entity B buys a bond on January 1st of year N, 10,000 bonds with a fixed interest rate for a total amount of 1,000. Entity B does not want to hold the bonds until maturity. On December 31st of N, the fair value of the bonds is 1,050, so there was a value increase. In N+1, anticipating an interest rate increase and therefore fearing lower bond values, entity B decides to cover the bonds against the fair value loss with a derivative with a cost of 0. So here we don't specify which derivative. Could be an interest rate future, could be a forward rate agreement that I sell. So different possibilities, but here we assume that the derivative has a cost of 0. Indeed, when I engage in unconditional derivatives such as futures and forward rate agreements and so on, or swaps, there is no initial cost. So we have a cost for conditional derivatives such as options. I need to pay an option premium at the beginning, or for credit default swaps, for example, where I need to pay premiums like an insurance premium actually. But here we assume we use a derivative that has a cost of 0. On December 31st of N+1, so 1 year later, after the interest rate increase, the fair value of the hedging instrument is now 9, so that's the derivative, while the fair value of the bond is 1,041. What are the accounting entries in N and N+1? So here we go. In N, what happens? Well, first we buy the bonds for 10,000. Okay, for 1,000. So there will be a cash outflow of 1,000, and I recognize a non-current financial asset for 1,000, because here the bonds apparently are not speculative. Otherwise, it would have said so. They are not speculative. And that's why we put them in the non-current section. And actually, as we see here, we keep them at least for 2 years, if not longer. Okay, now in year N, we are not yet in a hedging relationship. The hedge starts only in year n+1, not right away. That means in year n, there is no hedge accounting. We just do regular accounting for this bond. Okay, so we buy a bond. Apparently, it's a normal bond, so it is SPPI. That means we need to check the business model. Well, the only information that we have here is that we do not want to hold the bond until maturity. Okay, so it's not amortized cost. It's not speculative either, so it's unclear. Therefore, we assume here that the bond is accounted for as fair value through OCI. Okay, that is just an assumption. Obviously, we cannot directly deduct this from what is said on the slide. But here, let's assume we use fair value through OCI. That means at the end of year n, the fair value of the bonds have increased to 1,050. That means I need at the end of the year to increase the book value of my assets by 50. And this gain goes in other comprehensive income. Now, once again, because we assume fair value through OCI. Okay, so here for year n, nothing special. It's not hedge accounting, it's just regular accounting. Okay. I suppose you don't have questions so far. Well, if not, write in the chat something. In year n+1, so what happens? Well, here we made a gain on our investment. And now I'm afraid that in n+1 or later, the interest rates may increase. And of course, if interest rates increase, the bond prices will fall. So that means I may lose again this profit. And therefore, to assure that I keep the 50, basically, I engage in n+1 in a hedging relationship. Okay. And I engage in a derivative that has an original value of 0. Well, that means I could put an asset in my balance sheet that has a value of 0. That would be a possibility. Or I simply account for nothing. That's also possible. Okay, obviously, I need in my accounting somewhere, not in the balance sheet necessarily, I need in my accounting, obviously, a trace of my derivative. So even if I don't account for it, somewhere in my information system, I need information that I engaged in this derivative, what's the volume, the conditions, and so on, because obviously I cannot keep no trace of my derivative. Okay, so it means I do have the derivative, but as of now, the fair value is 0. Then we move to the end of year n+1. And now, indeed, the interest rates during n+1 did increase, and that means the fair value of my bonds has decreased. Therefore, I will account for a loss of 9, because at the end of year n+1, my portfolio value is 1,041. So I decrease that. And I put this loss immediately in the income statement, because in n+1, I am in a hedging relationship. Therefore, I apply hedge accounting. And here it is a fair value hedge. In a fair value hedge, all revaluation gains and losses go directly in the income statement. So I do not use OCI because I'm in this hedging relationship. So for the bonds, I made a loss of 9, and the loss goes in my income statement. But for the derivative, obviously the derivative has an opposed value evolution. At the end of the year, the derivative has a value of 9. So a favorable amount for me. Therefore, the derivative is an asset for me, a hedging derivative. That's what I would write probably in my balance sheet. And the original value was 0. Now I increase that value by 9. And that means, in other words, on my derivative, I have a gain of 9. And here's the same thing, derivatives in general and hedge accounting in particular. Well, the gain of 9 goes directly in the income statement. So that means here, obviously, we see that we have a perfect hedge because the gain and the loss of the hedged item and the hedging item perfectly match. And as we can see here, there is no impact on the income statement. Impact on the income statement is 0. And since here we have apparently a perfect hedge, this impact of 0 would continue. So even if interest rates move the other way, and we don't know how long this hedge lasts, many years maybe, every time the plus and the minus of the bond and the derivative will exactly match, and there will be no impact on the income statement. And therefore, well, that's why I did the fair value hedge. I wanted to protect my income statement from any losses. Okay, questions so far? Fair value hedge, everything is fair valued, and all fair value gains and losses go directly in the income statement, and then we are done. Okay, so the only thing that we don't see here is obviously the remaining amount, or the amount that we have in OCI. So obviously, since I'm in a hedging relationship, I do not use fair value through OCI anymore. And on the day I sell my bond, or maybe it arrives at maturity, then remember, we recycle the profit. And that means here plus 50 in OCI means it's a profit. On the day of sale or maturity of the bond, well, this profit will be included in the income statement. So that means that if I look at this transaction here, including the hedge over time, over the whole investment period, we see that the final and total impact on the income statement will be plus 50. And that means, in other words, the profit that I made in the first year is saved because of the hedge, and this profit then will hit the income statement when I sell the bonds, or when they come to maturity. So that means I can use hedge accounting not only to avoid losses, but here to secure a gain, basically, because overall we don't have a loss, but we will have a gain. Okay. Questions on that so far? Apparently not. Then let's have a look at the following exercise, exercise number 8, which indeed is on about fair value hedges. So in N, a bank purchases a bond for 10,000. At the end of the first year, the bond has a fair value of 11,000. In N+1, the bank wants to secure the gain on this investment and sells an interest rate future, and the future has a fair value of 0. That hedges perfectly the bond. At the end of N+1, the market interest rates have risen, and the future has now a positive fair value of 500, whereas the fair value of the bond has fallen to 10,500. In N+2, the bank sells the bond for 10,700 and settles the interest rate future for 300. Hedge accounting conditions are met. We do not consider expected losses. Remember, here we have a bond, so usually we would need to account for expected losses. In A, account for this hedge assuming that the bond is classified as financial instrument at fair value through profit and loss. And B, account for this hedge assuming that the bond is classified as fair value through OCI. Okay, so for the A part, we assume the bond is fair value through profit and loss, and then we hedge this with a derivative. So I give you 5 minutes to think about the accounting entries in that case, in situation A. Or do you want me to put you in groups for 10 minutes or 15 minutes? Then maybe you can work on A and B. Maybe let's do this. No, that's here. So let's do 7 groups. Okay, so I give you 15 minutes. And I put this one here. Okay, I give you 15 minutes. Are we good? Think about exercise number 7, A and B part. Let's do this. Okay. Hello, can you hear me now? All right, I think we're good. Sorry for that. Then let's continue and have a look at the solution of this exercise. Okay, so here we are. In a while, here we go. So in year N, we buy the financial instrument, the bonds, for 10,000. Therefore, I have a cash outflow of 10,000. Just hold it this way. I have a cash outflow of 10,000 and I recognize my bonds at fair value through profit and loss. Okay, no hedge accounting here. At the end of the year N, the value of the bonds has increased, so plus 1,000 here on the asset side. And since I'm the category fair value through profit and loss, we put the profit right away in the income statement as 1,000. So plus 1,000 on the asset side, plus 1,000 in profit and loss. In the second year, we engage in the hedging relationship. So I engage in the derivative that has a value of 0. At the end of the year, the derivative has a value of 500, and therefore there's a value increase for the hedging derivative. And this is recognized as a profit directly in the income statement of N+1. And my bond portfolio loses in value for 500. And therefore, I put this loss also directly in the income statement. And since here we have a perfect hedge, well, the profit and the loss in the income statement, obviously, they match. And the total impact is 0. And then the year 2, what I do is I sell my bonds and I sell them for 10,700. Okay, so therefore I have a cash inflow of 10,700. But the book value of my bonds is only 10,500. Okay, and if I sell an asset as a value higher than the book value, there is a profit. And therefore I have a profit of 2,000 in my income statement. And I settle the bond. Well, settling the I settle the future, and settling the future is like selling it, and I sell it for 300. Therefore, I have a cash inflow of 300, but the derivative has a book value of 500, which I cancel. It means here I sell the derivative as a lower value at the book value, and that generates a loss in my income statement of 200. That means also in period 2, the total impact on my income statement is 0 because I have a gain and a loss that perfectly match, basically. Okay, so if I look at my situation over 3 years, that means in year number 1, I have a profit of 1,000. In year N+1, I have a profit of 0. And in N+2, I also have a profit of 0. Okay, so that means total impact on my income statement over 3 years is 1,000. And this profit appears in year N because here I am in the category fair value through profit and loss. Actually, so do you have questions, please, on this solution? Any questions? Apparently not. So here, actually, we have a financial instrument that is classified as fair value through profit and loss. If that's the case, and I want to hedge this position, which first of all in real life would be questionable, because, well, if you have a financial instrument in fair value through profit and loss, that means very often it's a speculative financial instrument. And we do not hedge usually. We do not hedge speculative instruments. So therefore, I'm not sure that this example here corresponds to the reality, but assuming we do this anyway, okay, it could also be that I speculate, on the credit risk, but not on the interest rates, and I want to cover this against the interest rate risk. Why not? No? Okay, but anyway, if I have a financial asset, financial instrument in fair value through profit and loss, and I do hedge with derivatives, as we know, and derivatives are also accounted for as fair value through profit and loss, well, that means actually I do not need to use hedge accounting here in this situation A. Why not? Well, because if I don't hedge officially my position, but I just buy the bonds and I buy a derivative, but I'm not putting them in a hedging relationship, actually the outcome would be the same because the bonds are at fair value through profit and loss, and the derivatives are also always fair value through profit and loss. So my income statement would be protected automatically without using hedge accounting. And that makes it easier, of course, because remember, for hedge accounting, there is documentation. I need to prove the efficiency of my hedge before that and at the end of every year. And of course, that will be verified by the auditor, for example. For all these reasons, hedge accounting is quite some work. So if I want to avoid this, in this situation here, I don't need to use hedge accounting. Okay, still no questions here. Okay, then we move to the B part. So in the B part, the financial instruments are fair value through OCI. That means that corresponds basically to what we had in our slides. So in N, I will spend the 10,000 in cash and buy my financial instrument at fair value through OCI. At the end of the year, I need to revalue my position, but the gain is not in the income statement. The gain goes directly in OCI, as we can see here. Okay, and in year N, we are not yet in a hedging relationship. So I have a gain of 1,000 in OCI. In year N plus 1, now we do use hedge accounting. That means here my hedging derivative gains in value, and I put this as a profit in my income statement. My bond position loses in value, and I put this loss also directly in the income statement. Because I use hedge accounting, everything is through fair value through profit and loss. And the final impact on my income statement in N plus 1 is 0. Well, because I use hedge accounting. In N plus 2, well, I sell my bonds for 10,700. Therefore, there's a corresponding cash inflow. I delete the book value of my bonds, which is 10,500. And I have a profit, therefore, of 200 from selling the bonds. And I sell my hedging derivative for 300. The book value is 500. That means there will be a loss regarding the future of 200. And of course, the gain and the loss here of the sale, they compensate each other. And then last but not least, the gain that I had in OCI is recycled in the income statement. So it means the final impact on my income statement in N plus 2 will be 1,000. Okay, and that means here we are in the same situation as on our slides. We made a gain, a paper gain in year N. Sorry, not here, but in year N. In year N, we made a paper gain, and because of the hedge, we were able to secure this paper gain. So final impact on the income statements, there will be a profit, but only in year N plus 2. So it means basically the difference between the case A and the case B is in which period falls my profit. In case A, the profit was in year N. Here in case B, the profit is in year N plus 2. That's the difference between those two cases. Okay. That was, or that is, a fair value hedge. Any question on that, please? case or the slide. Okay. Apparently not. Then we have a look at the second possible hedge here, a cash flow hedge. And remember, hedges of net investments in foreign operations are accounted for in the same way. So here, in a cash flow hedge, as the name indicates, my main concern is not to protect my income statement, okay, but to protect my cash flows. So in other words, I want to avoid that I have to pay more for something than I originally forecasted or planned, or I want to avoid that I receive less cash than I forecasted. Okay, so here the cash flow is my main concern, not the income statement. Although cash flows do have an impact on the income statement one day or the other. So all this and the fact that I do a cash flow hedge has also an impact on the income statement. Okay, but that's not my concern. Okay, my focus here is on cash flows. So for example, hedge a forecasted purchase of an asset in a foreign currency against foreign exchange risk by buying a currency future. So can somebody tell us what the currency future is? Currency future. Yes, indeed. It's a contract with the right. Well, it's actually an obligation, with the obligation to buy or sell the currency at the future date. That is correct. And very important, obviously, the price for the currency. So in other words, the exchange rate is already fixed today. So today I engage in the future contract. So for whatever, $1 million. And we fix today already the price I have to pay in euros for those $1 million. And then in 6 months, I buy the dollars. I pay the euro amount that we fixed 6 months ago. And that means I am independent in 6 months. I'm independent when I buy my dollars from the exchange rate in 6 months. So when the dollar has appreciated, then I'm not concerned by this because I pay the amount that was fixed in the currency future. Okay, so here I have a forecasted purchase of an asset in dollar, for example. So that means I need a certain amount of dollars in 3 months, 6 months, 9 months. Okay, and in a currency future, I buy those dollars within the future. So that means in 9 months, in the future, I buy the dollars, then I take the dollars and I pay my asset, for example. Or hedge a variable interest rate liability against the risk of rising rates by entering an interest rate swap as payer. Okay, so do we know what an interest rate swap is? How does an interest rate swap work? Does anyone know, please? Any ideas? Interest rate swap. And you are a payer. Okay, so here in the second example, so imagine we have issued a variable interest rate liability, okay, as a debt. That means now, obviously, I'm afraid that interest rates in the market increase. And if interest rates increase, I need to pay more and more interest for my debt. So higher cash outflow than I originally thought. How will I hedge this risk? Well, I will enter into an interest rate swap. So let me see if I can write this down, how this works. Okay, so here is the company. I have a variable debt. Now, what I will do is I will engage usually with the bank. Let's put it this here. Usually with the bank. And what we do is we will exchange payments. Company pays interest bank, and the bank pays variable interest to. Okay, so it means in an interest rate swap, what we do is we exchange interest payments. So, and here I'm on the payer side. Okay, so that means I pay fixed interest to the bank. In exchange, I receive variable interest from the bank. And since I have a variable interest debt, I take this variable interest that I receive from the bank and I pass it on to the market. And that means now I am immune to any change in interest rates, in particular, of course, to an increase in interest rates. Because if interest rates in the markets increase, I will receive more payments from the bank, and I will, move or transfer those higher payments that I receive from the bank to the market. On the other hand, if interest rates decrease, well, I will receive less from the bank. I will give less to the market, but I still need to pay, obviously, my fixed interest because I'm engaged in this interest rate swap. Okay, so interest rate swaps are a common tool. Actually, this is used to convert variable interest into fixed interest or vice versa. Obviously, if I think that interest rates will decrease, then maybe I want to get out of my fixed rate debt and I want to transfer this or transform this into a variable interest debt. And that's also possible either way. Okay, so these are interest rate swaps. And the payer, actually, as it says here, the payer is actually the party that pays the fixed interest. Okay, so these are examples for cash flow hedges. How do I do the accounting? Well, here the interesting thing is that the hedged item actually usually will not be visible in my balance sheet. Why not? Well, because here what do I hedge? I hedge future cash outflows, for example. So here I hedge a forecasted purchase. So I engage the hedge today, but obviously the purchase has not yet happened, and therefore there is nothing in the balance sheet. Okay? Or here I hedge future interest rate payments, but obviously future interest rate payments are not accounted for. They will be accounted for when the interest payments take place, but not before. That means the hedged item, well, basically there's nothing to do, mostly, there are some exceptions, but mostly there's nothing to do because the hedged item, so the hedged cash flows, are future cash flows and they're not yet accounted for. That means the only accounting I need to do is for the hedging instrument as such. And here we do the same thing as before. Remember, hedging instruments are derivatives mostly. And that means I will fair value my derivative. That never changes. But this time, the fair value gains and losses, they are put in equity. More precisely, in other comprehensive income. Okay, so the derivative is on the balance sheet and is fair valued all the time. The fair value gains and losses go in OCI. Why in OCI? Well, because the OCI here is more or less a waiting position. I will use those gains and losses in OCI when the actual cash flows happen. And then I will recycle the amounts in OCI. Okay, so fair value the derivative in the balance sheet, all fair value gains and losses go in OCI. OCI is recycled when the cash flows actually realize. However, we do this only for the effective portion of this hedge. For the ineffective portion, the gains and losses go in profit and loss. Now, here we have to be careful. What does ineffective mean? Because remember, we said previously that it is not necessary for hedge accounting, to apply hedge accounting, it is not necessary to have a 100% hedge effectiveness. So anyway, I can do a hedge and it is ineffective because it's not a 100% match. But not all of these is what we call ineffective here. Actually, in a cash flow hedge, ineffective is defined as when the value change of the derivative is higher than the value change of the hedged item. Okay. So, for example, if my derivative increases by 10, okay, that's the value change of my derivative, and the hedged item decreases, remember it moves in the opposite direction, decreases by 11, okay, we do have a hedge that is not perfect, and therefore there is some inefficiency here. It's not a perfect hedge, but it's not an ineffective hedge in a sense that I have an ineffective portion. That means here I would there would be nothing, everything would be recognized in OCI. The full 10 would go in OCI. Okay, there is no ineffective portion in a sense defined here, because the value change of the derivative is smaller than the value change of the hedged item. If, on the other hand, the derivative changes by 15, okay, assuming, and the hedged item changes by 11, then here we have an ineffective portion. No? And the ineffective portion would be 4. Because for 4, the derivatives changes more than the hedging instrument, or the hedged item. And that means, well, I overhedge in a sense. And the overhedge is considered as speculation. So here we cover actually more than I think, and the overlapping part is speculation. Any speculative gains related to derivatives must go in profit and loss. So that means basically for these 4, we fall back in regular derivative accounting, even if the derivative is not part of hedge accounting. That's actually speculation. And therefore, speculative gains go in the income statement. Okay, so the effective part goes in OCI. Any inefficiencies potentially, as defined here, go in the income statement, and the hedged item and the cash flows relating this as such, they are not accounted for yet. Okay, any theoretical questions so far? That's not the case. So then we do exercise 8 on this, but I propose that we do our dinner break now. Okay. And then, so I see you again at 8:30 for you, at 8:30, and then at 8:30 we'll do exercise number 8 together. Is that okay with you? See you in 30 minutes, roughly. Okay. All right. Okay, welcome back. So we were talking about the cash flow hedges. So let's see the exercise number 9 to see how this works. Exercise number 9. So in December N, the French airline Flyhigh signs a contract to buy an aircraft for $300 million to be delivered on February 15 in N+1. When signing the contract, the exchange rate is $1 for €1. And to cover the foreign exchange risk of a rising US dollar, Flyhigh is entering into foreign exchange future, so currency future, where it buys $300 million on February 15. And we assume that the forward contract has a fair value of 0 initially. We also assume a perfect hedge. And obviously, in our hedge, that means we buy the $300 million dollars, and we pay for this 300 million euros, which is the current exchange rate. On December 31st, the US dollar has appreciated against the euro, and the forward contract now has a positive value of 500,000. And on February 15 of N+1, the US dollar has again appreciated against the euro, and Flyhigh receives the aircraft and pays $300 million, and for this you need to pay 300.9 million euros, and receives 900,000 euros from settling the foreign exchange forward contract. Hedge conditions are met. Account for this hedge. Okay, so let's do this. Maybe we can do it in this way. I share all of this. Here we go. Okay, so in year N, we sign a contract to buy an aircraft for 300,000 to be delivered in February next year. What is my accounting entry for this order? Because well, the best way of doing this is in the chronological order. So when you sign a contract to buy an aircraft, what are your accounting entries, please? Can someone tell me? Nothing. Well, that's correct. Because ordering something is not a transaction. That means when we sign the contract, there is no accounting entry. Okay, but we also sign up for the future. Okay, the foreign exchange future, the currency future. Well, when I sign up for the future, it has a fair value of 0. Well, that means there is no accounting entry to be done. Okay, therefore we are good. But at the end of the year, on December 31st N, the future has now, for me, a positive value of 500,000. Okay, so that means now in my balance sheet, in my current assets, because here it's short term, I will recognize a hedging derivative. And the original value is 0, but at the end of the year, the value has increased by 500,000. So I have plus 500,000 on the asset side. Okay, and at the same time, well, it's a cash flow hedge, and the fair value gains and losses of the hedging derivative, as long as the cash flows are not happening, are recognized in OCI, so directly in equity. That means here my OCI also increases by 500,000. So at the end of year N, I have plus 500,000 on the asset side of the balance sheet and plus 500,000 on the other side. Hypothetically, what would be the case if, because here my hedging derivative has a positive value because the dollar appreciated against the euro, but if against my forecast the dollar had depreciated against the euro, actually my derivative would be a bad contract for me. So imagine that at the end of the year, I would lose, let's say, 300,000 because of my derivative. What would be my accounting entry in this case? Well, if the derivative value moves in the wrong direction from my forecast perspective, I would recognize a hedging derivative as liability. And if we assume that the value is 300,000, that would be a loss, and the loss would be recognized in OCI. So either the derivative moves in, or the value of the derivative moves in the right direction, and then it's an OCI gain, or the derivative moves in the wrong direction, then it's an OCI loss. But here we have a gain. Okay, so far so good. That's the situation at the end of December N. And now we move forward to February 15, where several things happen. Well, first of all, the aircraft is delivered, and I take position of the aircraft. And also, I will settle my currency future, for which I will receive 900,000. Okay, now there's different ways how to do this. Okay, and when I take possession of my aircraft, I need to pay $300 million, and at the date of executing contract, February 15, that means I have to pay 300.9 million euros. Okay, so what will happen in the following year? Well, first of all, I will buy my aircraft. Okay, and therefore, let me put it this way. Okay, I will have a cash outflow of how much? Well, 300 million and 900, because remember, my accounting is in euro, and the euro price I pay for my aircraft is 300.9 million. And I will account for my aircraft, and starting value is, well, 900 million. Okay. Secondly, well, doesn't matter which order, I could revalue my hedging derivative. Now remember that at the end of the year, the value, or on February 15 in N+1, the value of my hedging derivative has increased to 900,000. So there's a gain of 400,000. Still hedge accounting, so I will put the gain in OCI. Okay, and now I settle my future, which means actually I will sell it for 900,000. Okay, well, selling means I will have a cash inflow of 900,000 for my future, and in exchange, obviously, the book value of the future, which is also 900,000, would taken out of the balance sheet. That means here now you see the reason why we actually did this swap, the future actually, or the hedge, because now my total cash outflow is only 300 million on a net basis. And that means, well, I secured the exchange rate at the date I signed the contract, because at the date I signed the contract, it was €1 equals $1, and therefore $300 million equals 300 million euros. So here actually, because of the hedge, my total cash outflow, net cash outflow, is 300 million, the amount that I wanted. Okay, so far so good. But still now we have 900,000 in OCI, and OCI needs to be recycled when the cash flows happen. Okay, now the cash flows did happen. That means now I need to recycle. So that means we have to check what the hedge was about. Well, the hedge was about the aircraft. And we all agree that in euro, the real purchase price of the aircraft is not 300.9, but only 300. But because of the hedge, the purchase price is lower than what I actually paid to the supplier. And therefore, what I will do is I will recycle the profit here of 900,000. And how will I do this? I will deduct it from the book value of my asset. Means that the final book value of my asset is also only 300 million. And that means also, of course, that I will depreciate only 300 million as an aircraft value, and not 300.9 million. That means my depreciation expense will be lower than it would have been without the hedging transaction. So, as I said before, it's a cash flow hedge, but there is an impact on the income statement. Well, here the impact is over time because of depreciation. Maybe I hedged here not the purchase of an aircraft, but the purchase of inventory. Well, okay, well, that means the inventory value is lower, and there will be an impact on the income statement when I recognize the cost of goods sold of this inventory, which will be lower than without this hedge. Okay. So once again, the income statement is not my main focus. It's the cash flows. And here, because of this hedging operation, I assured that I pay only 300 million for my aircraft and not 300.9 million, which would be the exchange rate at the date we get delivery of the aircraft, which is February 15. Okay. Do you have questions here on the hedge accounting? Questions? So the purpose of hedging is to mitigate risk, to reduce risk. Okay, that's what we do here. But obviously, if you reduce risk, you also may reduce the chance of making an extra profit. And here in our case, for example, actually the purchase price of my aircraft will always be 300 million, independently of how the exchange rate dollar-euro moves. Okay, so maybe the exchange rate moves in a way that is favorable for me, and actually the $300 million at the date of payment, February 15, would require less than 300 million euros to buy on the market. But because of my hedge, I will always pay 300 million. So the hedge here takes me away the risk, okay, but it also obviously takes away the possibility to make an extra profit and maybe benefit from a market evolution of the exchange rate or interest rate and so on, benefit from a market evolution that is actually positive for me. So the hedge takes away the risk for negative market evolution, but it also takes away the possibility to benefit from positive market evolutions. So here the purchase price of my aircraft will be 300 million, completely independent on what the exchange rate does. It increases, it decreases, it doesn't matter. I'm completely immune to that. That's why many companies actually very often do not hedge 100% of their foreign exchange risk. They hedge like 80% or 90%. And that means they leave a small window open of 10 or 20%. On this window, they still have risk, but also they still have the possibility to make an extra profit. Okay. And in order to eventually benefit from this, that's why they leave that open. So therefore, for foreign exchange transactions, very often we do not have 100% hedge, not perfect hedge. Okay, that's it for exercise number 8. Any questions, please, from your side regarding hedge accounting? Because we are done with that. No questions. Okay. Then let's move to the last part where we talk about impairments and impairment testing and provisions. Okay, so maybe before we do this, some general considerations regarding impairments. Okay. What is an impairment? An impairment is a loss of value. Okay. And we know already other losses of values, for example, depreciation. Depreciation is also a loss of value. But for depreciation, we lower the book value of our asset and we put a depreciation expense in the income statement. But maybe you heard already about impairment. What is the difference between impairment losses and depreciation losses, if you want to call it like this? Any idea? What's the difference between depreciation and impairment? No idea. Have you heard about impairment before? Well, probably not. Apparently not. So depreciation, we could say, is a systematic and planned loss of value. Why systematic? Well, because we do a depreciation schedule, and therefore I know I buy a machine, I use it over 10 years. I set up the depreciation schedule for 10 years, and if nothing happens extraordinary, well, I stick to the depreciation schedule. So I know upfront over 10 years what the depreciation will be. Okay. Impairment, on the other hand, is unsystematic. It's unplanned. Okay, therefore, I call it bad surprise loss. That means, well, for 10 years, maybe there's no impairment whatsoever because your company does fine. And then suddenly in 1 year, well, you take huge impairment losses because rather bad stuff is happening, for example. Okay, so impairments are losses of value that are unplanned. They are bad surprise. Depreciation is not a surprise. I know exactly what's going on. There's also a difference in horizon, in perspective. A depreciation is accounted for a loss that has already happened. Because on December 31st, we depreciate the asset because during the year we use the asset. And that's why the book value of the asset at the end of the year is smaller, is lower than the book value than it was at the beginning of the year. Well, because during the year I used the asset, and therefore it's a loss of value that has already happened. That means it's a loss of value that is definite. Okay, which means it cannot be reversed. It's done on December 31st. The loss is there, and you cannot come back on this. Okay, impairment losses. Why do I account for impairment losses? Here it's a different story. Here we account for forecasted losses. So that means, well, since they are forecasted, they are estimated. So in other words, something bad happens in 22. Therefore, I think I will have a loss in 23 or later. The situation leads to an impairment. Okay, so we account for impairment losses in order to anticipate future losses, but very important, future losses that are originated, that are generated in the current year, in the year for which I set up the income statement. So for example, we had in 2020 and 2021 we had COVID. Obviously, that's a bad surprise, bad news for many companies. And many companies made losses in 20 and in 21. Okay, but the COVID has also consequences that will last much longer. If you think about the airline industry, they think about that probably it will be until 25 before the airline market is back to where it was before COVID. That means the bad stuff that happened in 20 and 21 has not only consequences for the income statements of 20 and 21, it had also consequences for 23, 24, 25, maybe for many years. Okay. And we account for impairment losses because we need to anticipate those losses as long as they are generated in the current year. Okay. That means whereas depreciation is a definite loss that is fixed, here we have a forecasted estimated loss, which means obviously those losses are not definite. Today I may be very pessimist, but maybe good things happen in the future and maybe the losses are smaller than I anticipated. That means an impairment loss can be reversed. I can cancel an impairment loss if things turn out better than I thought. Okay, so impairment is a loss of value of an asset and an impairment expense in the income statement. Depreciation is a loss of value of an asset and a depreciation expense in the income statement. So technically, we are talking about exactly the same thing, but as you can see here, there are some fundamental differences between depreciation, which is planned and forecasted, and impairments, which are not at all forecasted. And the last difference is that impairments are possible for all assets. So I can have impairment losses for property, plant, and equipment, for brand name, for financial assets, but also for accounts receivables, for inventory, etc. Whereas depreciation only for non-current assets, property, plant, and equipment, and so on, and only for non-current asset with a limited useful life. So, for example, a piece of land is not depreciated. A brand name usually is not amortized because the useful life is indefinite, is unlimited. That means the scope of application of impairment is much bigger. Okay, so these are some fundamental differences between impairments and depreciation, although from the accounting technique here, we're talking about the same thing. So in order to know if I need to do an impairment or not, I need to do an impairment test. So here's something about vocabulary. Usually I talk about an impairment test only when we talk about impairments for non-current assets. Okay, so in terms of terminology. Nevertheless, as I said before, you also do an impairment test on current assets. Okay, you do it, except that you don't use the word. So I will impair my accounts receivables, and obviously to do this, I need to check it out and test it, but I will not use the terminology impairment test for accounts receivable. So therefore, when you hear impairment test, we talk usually only about non-current assets. Okay. All right. So what is an impairment test actually? What does that mean? Well, it means I will compare the book value of my asset, so the accounting value asset, compared to, I will call it generally a benchmark value. Benchmark value. So benchmark value, it's not an official terminology, it's my personal terminology. So we need a comparative value, and I call this in general benchmark value because the value I use as benchmark depends on the type of asset that we are looking for. or at, for which item we are doing the impairment test. So for example, for accounts receivable, I would compare the book value of the accounts receivable. In other words, the amount that the client owes me because of our contract. And the benchmark value would be the expected amount that the client will pay. So here, book value compared to expected payment of the client. If I check my inventory for impairment, I would compare the book value of my inventory to the net realizable value. So in other words, the selling price of my inventory, if we talk about finished products, for example. Okay, but anyway, I will compare the book value with the benchmark value. And I when do this comparison, obviously there are two possible outcomes. First one is the book value is smaller than the benchmark value. First possibility. Or second possibility, the book value can be bigger, higher than the benchmark value. So accounting principles, and in particular the accounting principle of prudence or conservatism states that if in accounting we have the choice between two values, on the asset side I should choose systematically the lower value. Except obviously when I do fair value accounting, but other than that I should choose the lower value. So here, if my book value is lower than the benchmark value, well, I should choose the book value, okay? But the book value is what I have already in my balance sheet, which means there is nothing to do. And in this case, there is no impairment. And okay, I did the impairment test, but as a result of the impairment test, well, I have already the lower value. So therefore, there's nothing to do. In the second situation, obviously it's different. Now the benchmark value is lower than the book value. And that means here I need to impair. Here I do have an impairment. And therefore I need to write down the asset to the lower benchmark value. And that is what generates my impairment loss or my impairment expense. Okay, so impairment test is compare the book value with a benchmark value. When the book value is lower, there's nothing to do and there's no impairment. When the benchmark value is lower, then that's when we have an impairment and we need to write down the asset. Okay. So here we talk about, or in part 4, we talk about impairment testing for non-current assets only, not for accounts receivable or inventory and other things. Okay, and there are specific rules for impairment testing of non-current assets. So first of all, for property, plant, and equipment in general, and for intangible assets with a limited, so-called definite useful life, I do an impairment test only when there are impairment indications. Okay, so that means there has to be actual bad news, because bad news potentially leads to a bad surprise loss. The impairment indication can come from the outside of the company, so decline in market values, changes in technology, new competitors, etc. Or the indications can come from inside the company. So, for example, that I have a machine and in the last quarter it broke down all the time. Well, that means probably the value of the machine is lower than I still have it on my books. Okay. So for property, plant, and equipment and intangible assets with a definite useful life, I do an impairment test only when there is impairment indication. Why? Well, because most of these assets are already depreciated. Okay, so that means every year I do reduce already the book value. It's getting lower and lower year after year. And that means, well, if in addition to depreciation there's another loss, well, it's only the case when there's really bad news. And really bad news, well, is measured with those indications, external or internal. However, for indefinite life intangible assets, so intangible assets that do not have a limited useful life and therefore are not amortized, that includes goodwill, we need to do an impairment test every year. So here, since I stick with the original book value, I need to test every year if, well, maybe there is a loss of value. Okay, so impairment testing for non-current assets, not all the time. It depends on what type of asset. Okay, as I said, in an impairment test, you need to compare the book value, which is also called carrying amount, with a benchmark value. And the benchmark value for non-current assets is the recoverable amount. So in other words, the amount of money I can make by using, or the amount of money I can make with my asset. Okay, how can I make money with my asset? Well, there's two possibilities. Either I could sell my asset, and in this case, I would get the fair value, so the market value of my asset minus the cost to sell. So either I can sell my asset or I can use the asset myself. Well, when I use the asset myself, I produce products with it. I can sell the products on the market, and therefore my use of the asset generates cash inflows from selling those products. Okay, so either I use my asset myself or I sell it. And the higher of those two values is what we use as recoverable amount. According to the idea that logically, if I have a choice of making money with my asset by using it or by selling it, I would choose the possibility that generates the highest value for me. If that's the sale, then I should sell it. If that's the using it myself, I should use it myself. And therefore, as a reference, as a benchmark, we take the higher of those two values, fair value, less cost to sell, or value in use, either one of them. How do I calculate the value in use when I use the equipment myself? Well, it's the present value of the cash flows that I generate myself from using the asset. And therefore, usually we do forecast a maximum over 5 years. And obviously, I only look at the cash flows of the asset. I do not look at cash flows that are around that, like cash flows for financing or income tax. When I calculate the present value of future cash flows, I need a discount rate. Well, I should use a rate that reflects the current market assessment. Most companies, however, use the weighted average cost of capital that they have in the company. Okay, so value in use is present value of future cash flows. Fair value is the selling price, basically, today minus cost to sell. Okay, then let's do an example here. At the end of N, Verma company tests the machine for impairment. The machine has a carrying amount, a book value of 200,000. It has an estimated remaining useful life of 5 years. And because there's little market-related information on which to base a recoverable amount based on fair value, we only use here, or we only calculate here, the value in use. We have a discount rate of 8%, and Verma's analysis indicates that its future cash flows will be 40,000 each year for 5 years. Okay, so to calculate the value in use, I need to calculate the present value of the cash flows. 5 cash flows of 40,000 discounted with 8% lead to a present value of 160,000. It's a rounded number. It's not precisely 160, but it's around 160. And that means the value in use that I take as a benchmark here is 160. Okay, so in other words, 200,000 is the book value, 160 is the value in use. That means in our decision tree, we have the book value of 200,000. We have no fair value because it's unknown, but we have a value in use of 160, and the same value in use is my benchmark value, my recoverable amount. And here in this situation, well, the recoverable amount is smaller than the book value, and that means, well, I need an impairment, and the impairment loss is 40,000. That means I need to reduce the book value from 200,000 down to the lower benchmark value, to the lower recoverable amount of 160. Okay, so far so good. How do I do this? Well, in my balance sheet, I have the book value of 200,000. In the income statement, I have already a depreciation expense that has been deducted here. So obviously here for a machine, I have depreciation every year, and in addition, I may have impairment. Well, depreciation always comes first. Because remember, depreciation is for a realized loss of value, therefore I have to do it, etc. So I will always account for the depreciation expense first. That leads to the book value, and this book value then is compared with the recoverable amount. So therefore here I have a book value of 200,000 after depreciation, whose amount I do not know, and it doesn't matter here. And now I need to account for an impairment loss of 40,000, and those 40,000 are deducted from my book value. So that after doing this, now I see that the new book value of my machine is 160,000. Okay, and here we see that technically depreciation expense and impairment expense are the same thing. There's a loss of value in the income statement. There is a decrease of value in the machine. But for example, there is no cash outflow, obviously corresponding to the depreciation or corresponding to the impairment. All right, questions so far? No questions. Well, if in N I account for an impairment, and that means also there will be consequences on my financial statements in N+1, N+2 in the future. Why? Well, because I need now also to modify the depreciation of future years. Why? Well, because my original depreciation schedule, the one that I used here, was based on the acquisition cost of the asset and a book value of 200,000 at the end of N. But now I reduced the book value down to 160,000, and that means obviously when my remaining book value is 160, I cannot continue to still depreciate the remaining 200,000. That's not possible. Therefore, for the following years, N+1 and so on, I need to recalculate my depreciation. And how much do I need to depreciate? Well, I have the book value at the end of N. The remaining useful life is 5 years. And that means I have now a new depreciation of 32,000, which is lower, obviously, than the depreciation before. Okay, that means next year I have a depreciation expense of 32,000, and so on. All right, questions so far, please, on the impairment here. Nope, apparently not. Okay, then let's do the exercise number 9. See how this works. So in January N, well, I let you read the case. Let me put this on the next page. So I let you read the case. Then we see what's going on. Okay, so here we have the situation. And the first question is, what value will appear for the building on Bilbao's balance sheet after 5 years? So on December 31st of N5. Okay. So let's calculate it. Let's calculate this. Well, I buy building for 2.5 million. And I can use it over 25 years. That means there is an annual depreciation of 100,000. 5 million over 25 years. Now I want the book value at the end of N5, so after 5 years. What is the book value? Well, it's the acquisition cost minus 5 years of depreciation. 5 years of depreciation is 500,000. So the book value at the end of N5 is 2 million. That's the answer to the first question. Okay. So far, so good. Second question is, what entries should be made on December 31st? Well, obviously, we have already to account for depreciation expense of 100,000 at the end of the year. But we also need to do an impairment test. Why do you think I need to do an impairment test here? Remember, for property, plant, and equipment, we said that we do an impairment test only when there are indications for a loss of value. So what is here my indication that there may be a loss of value of my building? Which information triggers my impairment test? Someone, please. Well, you mean the selling price, but I would check out the selling price only when I do an impairment test. But I'm one step ahead of before that. What tells me here I should even do an impairment test? Because if I don't do an impairment test, I don't, estimate the selling price. But what is the indicator here that there may be a loss of value, and therefore I need to estimate the selling price, and indeed the selling price is already lower than the book value. What is my impairment indication here? No one? Well, it's a market indicator because we realize that the price of office properties has fallen tremendously over the past year. Yes, okay. Didn't see that. You're right. So the prices, the market price have fallen. Well, that means I need to check if my office building still has the same value. So we need to do an impairment test. Okay. Once again, impairment test does not mean there's an impairment, but we test it. And therefore I need to calculate the recoverable amount, which is the higher of either selling price or value in use. Okay, well, the selling price is already indicated here, 1.8 million. Therefore, I need now value in use. Okay, and how do I calculate the value in use? Well, it's the present value of cash flows. So what do we have? I receive an annual rent of 200,000. Okay, here, since the building is rented over 25 years, I have rent revenue of 200,000 over 25 years, and I need to discount them with a discount rate of 10%. So present value 200,000 over 25 years, discounted with 10%. Mistake here, obviously. The 200,000, I don't get them for 25%. I get them only for the remaining 20 years, because we do the impairment test in N5. So the remaining useful life obviously is only 20 years, not 25 years. So I have that for 20 years, and if I calculate this, it leads to approximately 1.7 million. So it's a little bit more, but for the sake of simplicity, 1.7 million. Okay, so that means my selling price today would be 1.8. My value in use would be 1.7. All right. That means I take as recoverable amount the higher of these two amounts, which is 1.8 million. Okay, so my recoverable amount is 1.8 million. All right, that's what I do here. The book value of my asset is 2 million, or carrying amount is 2 million. Well, that means here I need to account for an impairment loss of 200,000. Okay, that's what I have to do here. So therefore, what are the accounting entries at the end of N5? Well, account for depreciation expense of 100,000 and account for an impairment loss of 200,000. Okay, questions? No questions so far. Okay. And therefore, the last question relating to this: what will be the book value of the building on the balance sheet 1 year later? So 1 year after the impairment test. So the book value N6 will be the book value N5 minus depreciation, because remember, I need to continue to depreciate the asset. What is the book value N5? Can you tell me that? What is the book value N5? $2 million? No. Because the book value at the end of N5, 2 million, is before impairment. Final book value is how much? No, not 1.7. Because for how much impairment do I account for? 1.8. Exactly, Chung Tran. 1.8, because we have a book value before of 2 million. I decrease it by 200,000. That means the book value at the end of N5 after impairment and depreciation is 1.8 million. And how do I calculate my my depreciation that I need to account for in N6? How do I account for that? Or how do I calculate it, please? Exactly 1.8 million over the remaining useful life of 20 years. Okay, which is actually 90,000. Okay, so my depreciation is 90,000, and therefore the book value at the end of year 6 will be 1,710,000. Okay, so we have to recalculate the depreciation based on the new book value after impairment. So you can see that my depreciation expense now is 90,000 compared to 100,000 before the impairment. Well, obviously, since the impairment is already a big loss of value in one shot, that has a reducing impact on the depreciation that comes after, which is obviously completely logic. Okay, that's it on this exercise on impairment. Questions? Okay, not really. Then let's continue with the impairment. Okay. Well, you know, in order to calculate the value in use of an asset, I need to calculate the present value of the cash flows generated by this asset. But what do I do if I cannot determine the cash flows of the asset? Well, simply because the asset alone does not generate any cash flows. It generates cash flows only in combination with other assets. If you think about in a factory, an assembly line with a multitude of machines, well, what is the cash flow generated by one machine? Well, I can't really tell because it's part of the whole assembly line. Only the whole factory or the whole assembly line generates cash flows, but not the individual machine, for example. When I want to do an impairment test on a brand name, well, what is the cash flow generated by the brand name? Well, I don't know, because the brand name alone does not generate cash flows. It generates only cash flows together with all the other assets in the company. And that means if I have assets that do not generate cash flows on their own, I need to do my impairment test not on the individual asset level, but on a group level. And the group of assets that I use for my impairment tests are called cash generating units, CGUs. And well, the CGU may be the factory that I have for a product. Or you have stores in a retail store chain that may be a cash generating unit, or magazine titles if the advertising and direct sales are separated from other titles. So a cash generating unit is a group of assets that generates cash flows independently from other groups of assets or other individual assets. So we see that very well in stores in a retail store chain, because here every store obviously generates cash flows independent from other stores. And therefore, I can calculate the forecasted cash flows for the whole store. That means for the whole cash generating unit. And then I do an impairment test for the whole unit, and not for the individual assets that are inside the unit. So example here for Peugeot, well, now they're called Stellantis. So you see that the automobile division comprises a number of vehicle cash generating units, each corresponding to a vehicle model. Okay, so it means they have a multitude of cash generating units just for the automobile division. That's just one division. They also have the equipment division, and there they have several cash generating units corresponding to a program. Okay, so that means they don't tell us here how many cash generating units they have, but already the different vehicle models that they have in the group, we can assume there are 10, 20, 30, 40 cash generating units. And that means they have to do an impairment test for each of those cash generating units. Okay, let's see how this works. So imagine here Colby Corporation has 3 divisions. It purchased one division 4 years ago for 2 million. Unfortunately, PRIT experienced operating losses over the last 3 quarters. Colby management is now reviewing the division, which is also a cash generating unit, for its annual impairment testing. And we see that the net assets of PRIT are here listed. So we have all the assets. Obviously, for cash generating units, we need to allocate the assets and liabilities. And here we have a net value, a net book value, you could say, of our cash generating unit of 2.4 million. And we see, for example, that part of the assets here in the cash generating unit is goodwill. Okay. Well, that means, remember in part 2, when we did the consolidation, I need not only to calculate the goodwill, but I also, inside the target company, I need to allocate the goodwill to different cash generating units, if that is possible. Okay, so that means in real life, the goodwill calculation and the following allocation actually is much more complicated than what we just did in our exercises in the second part of this class. Okay, but anyway, here the value is 2.4 million. Assumingly, we don't know what the selling price is, and we calculate the value in use, forecasted cash flows and so on, of 1.9 million. Well, the 1.9 million will be our recoverable amount. Since the book value of my cash generating unit is 2.4 million, that means here I have an impairment loss of 500,000. Okay. So we see a methodology, it's the same if I do an impairment test for an individual asset or for cash generating unit. Obviously, for cash generating unit, it's a little bit more complex to calculate the value in use, for example. Okay, so here, as a result of our impairment test, there is an impairment loss of 500,000. But now I have a follow-up problem. Problem is, where do I account this impairment loss? Because actually in my balance sheet, I don't see the book value of my cash generating unit individually. What I do see is the book values of all my assets. That's what I see, because we have PPE, goodwill, inventory, and all that. That means now I have a loss of 500,000, but I do not know on which of those assets we do have the loss individually. Well, I don't know. That's why I did an impairment test for the whole cash generating unit. And since I cannot deduct the 500,000 from the total value of the cash generating unit, I need to deduct it from individual assets. Okay, well, I need a rule how to do that. Where do I take the 500,000 from? And the rules are given in IAS number 36. And the first rule is I will reduce the book value of goodwill first. Okay, so if there is a goodwill in the cash generating unit, any impairment loss will first be allocated to goodwill. Well, you can understand why, what we saw in the second part, because, well, goodwill, it's expected synergies, its future outlook, and so on. And since I have an impairment here, we can assume that the future outlook is not as good as it was before, which means goodwill is not as high as it was when I bought the company. That's one reason. We could also say goodwill, we don't really know what it is, because it's a residual amount calculation-wise, and therefore any loss is taken out of goodwill directly, and then we check for the other stuff. If the impairment loss is higher than goodwill, that means I will bring down goodwill down to 0 and no more goodwill. Then, so if the goodwill, if the impairment loss, sorry, is higher than goodwill, then for the remaining loss that has not been allocated to goodwill, I need to reduce the book value of the other assets that are still in my cash generating unit. Okay, and I will do this on a proportionate basis depending on the book value of each asset in the cash generating unit. Okay, so that means for our case here, we do have goodwill in our cash generating unit. The total impairment loss is 500,000, and therefore I will take out the 500,000 impairment loss first on goodwill, and we see here the goodwill can absorb this impairment loss. Okay, so let's do this. Okay, that means my goodwill book value is 500,000 and the whole impairment loss will be deducted from goodwill. And obviously I have an impairment loss in my income statement as a corresponding part. Okay, that's it for doing an impairment test on a cash generating unit basis, not on an individual asset. That means I have multiple impairment tests on individual assets and then on cash generating units. And then, well, I see for the whole group what type of impairments we do have. Questions? No questions so far. Okay, then let's continue. As I said before, impairments are forecasted losses, and therefore maybe my forecast is incorrect in the sense that, well, the situation improves over time, and finally the losses are smaller than what I thought originally. Well, in this case, I need to reverse the impairment loss. So at the end of every year, I have to check if my prior impairment loss is still valid, or maybe it has become bigger, then I need an additional impairment loss, or it has become smaller, then I need to reverse the impairment loss. Well, we see here when I account for an impairment loss, it generates an expense and a decrease of book value. When I reverse an impairment loss, well, it will generate a revenue reversal of impairment, and I will re-increase again the book value of my asset. Okay, so I cancel basically the loss of value that I had previously. So I can do this everywhere except for goodwill. That's the exception. So impairment losses that have been allocated to goodwill can never be reversed. So here I deducted 500,000. Therefore, it is not possible to write up the goodwill amount again. That's not possible. Cannot be reversed. Okay? Because once again, well, we don't know really what goodwill is. And therefore, we don't know if the reversal means I did not have the loss of value of the previous goodwill, possible, or maybe the reversal means I created a new goodwill. And the goodwill that I generate myself internally cannot be accounted for, only the goodwill that I pay for in an acquisition process. Okay, that's it on impairments. Questions on impairments in general? That's not the case. Okay. Then we discuss the last point in our program, which are provisions. Okay, I said earlier, impairments are forecasted losses because of a bad event that happened in the current year. Well, provisions have the same idea. I account for a loss, I anticipate for a loss that may happen in the future, but this future loss is based on bad news in the current year. Okay, and therefore I set up a provision. So impairment and provision have the same meaning. What is the difference? Well, the difference is that impairment losses are linked to assets, and therefore I reduce the asset value. Provision losses are not related to assets. Therefore, I cannot reduce an asset value because of a provision. And therefore, instead of reducing an asset value, I will recognize a liability. So provisions are liabilities, basically. All liabilities are obligations. That means here, as you see, we have different types of obligations depending on the degree of certainty. That's what makes a distinction. So for regular liabilities and accrued liabilities, I'm not making the difference here, because in the balance sheet you wouldn't see the difference. Three criteria or three elements are certain. The existence of the liability, of the obligation, the maturity of the obligation, and the amount. I know these three items precisely, therefore I can exactly put an amount on liabilities or accrued liabilities. Provisions means that for all the three elements, there is some uncertainty, but there is a probability. So provision, does a provision exist really? Well, no, but it is probable that it exists. So here there's just a probability, but the maturity of the provision and the amount is uncertain. So example, somebody sues my company and okay, if somebody sues my company, some litigation, does that mean I need to pay? I have an obligation to pay because somebody's suing me or not? Well, that depends. That depends on if it is probable that I will lose the litigation. If I think it is probable I will lose the litigation, well, I have a probable obligation. The timing, the maturity of the obligation is unclear because it depends on when we have the final verdict. Is that in 2 years, in 4 years, in 10 years? I don't know. Depends on how long the litigation lasts. And the amount that I have probably to pay is also uncertain because that depends also on the final verdict. So I don't know exactly how much that will be, but I can make an estimate. Okay, so probable obligation, uncertain timing, uncertain amount, but I can make a reliable estimate. Then I will account for a provision in the balance sheet. And we have finally contingent liabilities. They are not on the balance sheet, so we don't see them on the balance sheet because there is uncertainty in timing and amount, and also no probability in terms of existence. So it's very, very unlikely that this contingent liability will turn into a real obligation. Therefore, contingent liabilities are not recorded on the balance sheet. They may be recorded in the notes to the financial statements if it is important to know, because, I don't know, it may be an important litigation that I think I will win, okay, but if I lose, could have dramatic consequences. And therefore, I inform people about this in the notes. Okay, in order to account for provision, 4 criteria have to be met. I need a present obligation. Yes, the obligation has to be based on past events, okay, not future events. The obligation will result in an outflow of resources. Usually that means I have to pay something to get rid of the obligation. And number 4, because here we talk about uncertain provisions that are probable, I need to be able to do a reliable estimate. If those 4 conditions are met, I recognize a provision. If not, I don't. And I cannot, of course. Okay, so for every situation, we need to monitor this. Examples are litigation provisions, warranty provisions, restructuring provisions, environmental damages, so I run a factory, for example, but the government obliges me to clean up the environment once I stop polluting. And that would be an environmental provision. or pension benefits, when the company promises pension payments to its employees directly. In all those cases, we need to account for provisions if the 4 criteria are met. Okay, so let's do the exercise number 10 to see how this works. Or 11, sorry, exercise number 11. So in all those cases, we need to see if we account for provision or not. That means the 4 criteria have to be checked. Okay, number 1, an entity was sued for patent infringement by a competitor. According to the legal opinion and other facts, there's a 30% probability that we win the case, in which case we wouldn't pay anything. There's a probability of 45% that we can reach a settlement, and that would cost 20 million. And there's a 25% probability that we lose the case. And in this scenario, we probably need to pay 50 million. Okay, in order to see if there's a provision, we need the 4 criteria. So first of all, is there a present obligation? Question, yes or no? You think? So in other words, is it likely here that I lose the litigation? Or let's say, is it likely that I have an obligation? More likely to express like this. Well, we can say yes. Oh, okay. Go ahead. Hunkin, what do you want to write? Well, yes, because 45% probability that we pay something and 25% probability we lose. So it's very likely that one way or the other we have to pay something. So yes, okay. Is this obligation related to a past event? Well, yes. Actually, when my competitor is suing me, that's the past event. Will there be an outflow of resources? Well, yes, because there's a high probability that I need to pay an amount. Okay, and can I give a reliable estimate? Well, apparently yes, because I indicated already some indications. Okay, so that means I need to account for provision. Okay, so provision expense in the income statement and provision on the liability side. Question is, what is the amount of my provision? What do you think here? What should be the amount of my provision? Any idea? So we could have a weighted approach, 30% 0, 45% 20 million, etc. That's possible. We could take the worst case scenario, 50 million, maybe also possible. What do you think? 25% of 50 million. Well, so you mean 50 million in both cases? Or why not 50 million? That would be the worst case scenario. But in IFRS, we take the most probable outcome, and the most probable outcome is 45%. We will do a settlement, and therefore here I would account for a provision of 20 million. Okay, because that's the most probable outcome. Everything else is hypothetical or has a lower probability. All right, so I take the lowest outcome. All right, Second case, in N1, entity A signed a contract requiring delivery of 100,000 computer screens for a total price of 2 million. Expected time for production, let me put this on the following page. Expected time for production is from January to March N+2. The delivery is planned for March N2 as well. At the reporting date, A has not started with production and did not purchase the materials required for the production yet. Due to unexpected price increases for the components, the estimated production cost increased to 3 million. Termination of the contract would require A to pay a contract penalty for termination of 1.5 million. Okay, so it means I have a contract here. And well, does this contract lead to the accounting for provision? So first one, is there an obligation? Do I have an obligation here? Well, yes. Because either I need to deliver the products, and if I do this, I have production cost of 3 million, but I will get only 2 million. That means when I execute the contract, I will lose 1 million. I could also terminate the contract, but if I terminate the contract, I have to pay a penalty of 1.5 million. So yes, I do have an obligation. Is it related to a past event? Well, yes. The event is the signing of the contract. All right, that's the past event. Will it lead to an outflow of resources? Well, yes, because either way, I cannot get out of this contract without, paying something. Either I make a loss or I pay a fine. Either way. Can I make an estimate? Well, yes, because we have already the numbers. That means here, okay, we need a provision. Those provisions are called provisions for onerous contracts. In other words, loss-making contracts. This is a loss-making contract. The loss has to be anticipated as soon as I see it coming. So in N1, I will already account for the loss, although the loss will only be realized in N2 when I either execute or cancel the contract. So what do you think is the amount of my provision here? What is the amount of my provision? Well, 4.5 million is too much. Because here with the provision, we try to anticipate a future loss. My future loss is not 4.5 million. Okay, so we have 1.5 million. So in other words, the contract penalty possible, but 2.5 million. Why 2.5 million? That's not possible. Well, let's say it is possible, but it doesn't really make sense. Here we have, as I mentioned earlier, there's two possibilities that I have here as company. In case we do the contract, the loss is only 1 million, and this is correct. Okay, so 1 million, sorry. Here we are. 1 million will be the amount of my provision. Why? Because I can either, I can either execute the contract, so I have a cost of 3 million, but I will get revenues of 2 million, so the loss is 1 million, or I can cancel the contract, in which case I need to pay 1.5 million. So obviously, only for financial reasons already, it makes more sense to execute the contract and produce the products because it will minimize my loss. And I'm not even considering here client relationship reasons, because maybe the client will not be too happy when you cancel simply the contract. So there will be other consequences. So anyway, here the best solution for me, and therefore the rational one, is to execute the contract. That will generate a loss of 1 million. I need to anticipate this loss with the provision. Okay, in December N1, an oil exploration company is, due to its operations, contaminating the environment. The operations are in a country in which the cleaning up of those damages is not required by law. However, in the past, the company has always cleaned up the damages it caused and made this approach part of its company public policy. So question here, do I need to set up a provision for, cleaning up the environment? Well, the 4 criteria. Is there an obligation? You think? No. Okay, one possibility. Because it's not legally required. Someone else? No. Chongtren, because it's not legally required. Okay. But I tell you, yes, there is an obligation. This obligation is called an implicit obligation. The obligation in general can be explicit because the law requires it, but here we have an implicit obligation. What is the implicit obligation? Well, because in the past I have always cleaned up, and I tell so to everyone, in my reports, on the website, in my communication. I'm telling everyone that I'm an environmentally responsible company, and therefore I clean up independently of the law. Well, that creates an expectation. That creates an implicit obligation. And therefore here it would be very hard for the company to not clean up, because that would be against what they have said they would do. And therefore, yes, we do have an implicit, we do have an obligation. Is a past event, which is the pollution of the site, will be an outflow of resources because the cleanup has to be paid. And can I do a reliable estimate? Well, here we don't know. We have no information, but probably yes, because we did it in the past, so we can do it right now. Okay, so we need to account for provision here under the condition, obviously, that we can do reliable estimate, but we don't know the amount, because here we don't have any numbers. Okay. Well, let's finish that. Number 4. Government introduces a number of changes to the income tax system. As a result of these changes, an entity in the financial services sector would need to send a large part of its administrative and sales staff to training sessions in order to ensure continued compliance with financial services regulation. At the end of the reporting period so far, no training sessions had been attended by the employees. Okay, so in order to, keep the license of the company and so on, continue selling the products, I need a compliance requirement. For this, I need to send employees for training. These training sessions obviously have a cost. And the question is, should I set up a provision to cover for this cost? And that's the question. Well, we need to check the 4 criteria. Is there an obligation to do the training for my staff? What do you think? Is there an obligation to train my staff? Well, you tell me yes. Okay, well, as a solution, I tell you no. So that means an obligation is only given when there is no other way around this or out of this situation except training my staff. In this case, well, there would be an obligation, but I tell you, there are other solutions here. The company is not required to send their staff for training. What would be other solutions? What can the company do here? I don't want to send my employees for the training, I don't want to do it. And I'm not obliged to do it. What else can I do? Give me some alternatives here. And therefore, we don't have an obligation. Exactly. For example, I could outsource. That means I'm not proposing the products here anymore that require the training. I, stop producing them myself, and I subcontract this to somebody else. Or I could hire new staff that has already received the training, and therefore I don't need to do the training. Or I simply stop selling those products. Okay, I don't outsource, I just stop selling them because it's too costly to train the staff and so on. Okay, but that means here we don't have an obligation. Well, no obligation, no provision. So I don't need even to check the other condition because I need all four conditions. If the first one is not already met, well, there's nothing to do. Okay, and the last one, a furnace has a lining that needs to be replaced every 5 years for technical reasons. At the end of the reporting date, the lining had been in use for 3 years. Okay, so do I need to set up a provision for the replacement of the lining? The first one, do I have an obligation for this replacement? Do I must replace the lining every 5 years? Is this mandatory? Implicitly, explicitly? You tell me yes, but why? Is this my only possibility? Or do I have alternatives here? Am I obliged to change the lining? Well, no. Maybe I change the lining not after 5 years, but after 6 or 7 years. Or maybe I don't change it at all, and after 5 years, I sell this furnace and I buy a new one. Or maybe I don't change it after 5 years, I continue to operate, and maybe, I don't know, the furnace explodes, or maybe it just continues to work as it did before. But here there's no obligation to change that, and therefore there's no provision. Again, an obligation is there's no other way out of this than doing what is supposed to be done here. Okay? So we need 4 conditions in order to account for provisions. And then we stop. Okay, sometimes, obviously, for example, for warranty provisions, the valuation is probability based on historical experience and based on the expected value of what I pay. So it's not always the highest probability, but it can also be a weighted average amount, like in this example, where we sell mobile phones, there's a warranty, and obviously with a certain percentage, people will come and ask for an exchange, and this is very expensive, but other people will come and ask just for a repair. And in this case, we have a smaller amount. And then the total provision will be based on this amount here, 54 million, which leads to a provision expense and a provision in the balance sheet. Okay, and that's it for this course. So there's a remaining exercise, okay, but you can check it out on your own. It's not very complicated. Okay. So do you have final questions on this case, please. Actually, I ask you to hold on for a minute now. I have to get the door. Sorry for that. I had to get the door because I received some papers to grade. So that's something obviously I had to get. Okay, so we are done with the program. Okay, I think the final exam is already scheduled. The final exam, as indicated, is 90 minutes. It will be based on cases, the cases that we did here in class. I will post, in the next 15, 30 minutes, I will post the solutions to the cases and also the professor version of the slides. So you have all the solutions and everything that you need to prepare. If in the meantime, as a preparation on the final exam, you have questions, do not hesitate to send me an email and I will happy to answer. Okay. Well, if you have no more final question, then we would stop this. Some people are writing, so I wait a little bit. Well, I will post all the solutions on Canvas. So I will do this right after the class. Okay, so, well, thank you very much. It was my pleasure. Obviously, online is not the optimal way of doing this. Okay, but that's the way it is. I wish you good luck for your future career. Obviously, I wish you good luck for the final exam. And again, if you have questions in the meantime, don't hesitate to contact me via the CFVG administration or directly. All right. Thank you very much. Good luck and take care. Bye-bye.